Hello, everyone. Welcome to Charts and Chats with Gordon Scott, CMT. That's me, and I'm glad you're here. I have very interesting things to have some very interesting things to share with you today here on Charts and Chats with Gordon Scott, CMT. That's me. And if you're here, I'm glad you get to see them because what I'm going to do is show you two stocks that I think are going to make excellent returns in the next weeks, months, and probably through the end of this year. And I'm going to, before I show you what the two stocks are, I'm going to show you why that's true. And I'm going to show you why this means that the rest of the market will likely trade well all the way into the end of 2021, the rest of the US stock market, that is. Um, I hope to be joined a little bit later today a little bit later in the session by Paul Botterill, who will um, come on and help me with some of the presentation. But if not, that's going to be okay too. We have, as I say, two stocks. I'm going to show you the trades that you can set up. In fact, let me show you what the stocks are first, and then I'll come back, tell you why I think they're going to go up, and then we'll return and look at their trade setups that you can do with them. Here are the two stocks. As soon as I can share my screen and bring those up, let me just take a second to do that, and that should be shared. Okay. Hopefully you can see that the two stocks I have are Apple and Microsoft. Now, that's an interesting pair of stocks to choose. If you've listened to me for any length of time, you will know that I recognize Apple and Microsoft as the most influential stocks in the market. In fact, they're such strong bellwethers that if they both do the same thing, if they both are going somewhere, it's almost impossible for the rest of the market to not follow. Here's what I mean. Apple and Microsoft together form about 20% of the NASDAQ index. That is, their prices are calculated in such a way that their influence is mathematically figured into the NASDAQ 100 index. And the NASDAQ 100 index is the most influential indicator of where the S&P 500 is going to go. The technology sector in general tends to lead the Nasdaq 100 and the S&P 500 both. And the technology sector index, or I should say, the technology sector ETF that State Street publishes is based on an index for which Apple and Microsoft are 40% of the weightings. So Apple and Microsoft are tremendously influential. In fact, there's something like over 300 and almost 400 stocks that have, or ETFs, sorry, that have Apple in one of the top 15 of their allocations. So you got 400 ETFs out there, almost 400 ETFs that have Apple included in their mix, and not just included, but one of the top holdings, right? Then you have mutual funds, right? There are thousands of mutual funds, and a very large number of them trade with Apple, or I mean, have Apple as part of their holdings. Microsoft is almost identical in terms of the number of participants and the amount of representation. In fact, right now, Microsoft is the most capitalized, publicly traded, most highly capitalized, publicly traded stock in the world right now. I believe it's over 2 trillion. But these charts, what they show you is that both of these have hit new highs, right? You look at Apple and Microsoft and think, what now is a sucker's time to be a buyer of these stocks? They're way high, higher than they've ever been. How on earth could I expect to buy these? Surely the very next thing they're going to turn around and come right back down. That actually might be true. That is to say, they might pull back. Um, in fact, there's a 58% chance they'll at least pull back to where they gapped from last Friday. However, whether they pull back or not to that level, or even more, the chances that they are going to continue trending and keep going higher all the way to the end of the year are somewhere between 70 and 75%. Yes, I'm going to show you the research that that makes that belief uh, potentially provable. I don't know if it's provable. I don't know. Get, keep in mind, 75% is not 100%, right? But anyway, let me walk you through this fascinating idea. First off, I mean, just let's talk about some general theory of how things move in all markets, whether it's stock markets, futures, forex, whatever you talk about. What I'm about to tell you is the unknown secret. It's true. These next four slides are going to just reveal all movements in the market to you, at least a description. No, I'm not talking about Elliott wave or Wyckoff or any of that. Interesting and fun as those studies are, this is much simpler and much more provable. So there are two persistent kinds of movement in the market, either trending or channeling movements. Okay, let's define what those are real quick. Trending is that prices tend to make higher highs and higher lows. That's trending higher, right? Trending lower is lower highs and lows. Channeling movement means that prices tend to stay range bound. Now, they might go up but stay in a channel or down but stay in a channel. That's true too. But I'm really talking about stuff that over some period of time just kind of looks messy and choppy, not always perfectly in a channel, but in a general messy channel, right? That's the kind of stuff I'm talking about. That's called channeling movement. It's also known as reversion to the mean. This can be evidenced by the idea that prices are in some kind of range, but either way, they tend to return to average levels after a rapid rise or decline. So you get stocks breaking out of their most recent highs, like Apple and Microsoft did. But then the next move is for them to come right back and then just sort of stay there and not go anywhere. So that is channeling movement. Now that happens a lot enough. Um, and both of these happen a lot, right? Um, both of these are exploitable by trading various trading rules. The key thing is, what seems to be going on now, or in a way that I can recognize it and take advantage of it. That's what people make their decisions on. All right. So if you believe that you want to try to capture trending movement, well, the short answer to how to do it is typically trade longer time frames than you're used to. That's just do that. Set your trade up so that it will work for a little bit longer. If I say, well, I want to try and swing trade. I want to capture trades in 1 to 4 days. Okay, try thinking 1 to 4 weeks, and you'll have a better chance at capturing trends. And what that means is not just like, okay, I'll hold on longer. No, no, no. It means take position sizes that can put up with those, the bigger moves that would happen over a course of weeks as opposed to days. That might mean that, if you're going to trade 1,000 shares and swing trade thinking it's only going to drop, $2 or $3, I've got this $200,000 account. I can put up with, a $2,000 loss on an individual trade, no problem. No, no, trade 500 shares or 200 shares or something smaller, and then allow it to fluctuate $10 per share. Right? That's the kind of stuff I'm talking about. Okay, so it requires longer time frames. Value investors who typically have a time frame of 2 to 3 years if the trade goes well, and then they see it kind of take off in their favor, or position traders who kind of look for multi-month periods. These seek long-running trends, and they set up their trades in such a way that they can endure them. Oftentimes, they don't even use a stop loss at all. Value investors and position traders, right? And so they have to size their trades appropriately for that. Growth or momentum investors usually seek about a 1 year time frame. And these are growth or momentum investors who are looking for trending movement, right? And they do. I mean, if you say I'm a momentum investor, you're definitely looking for um, a trend. But the only difference between a value investor and a momentum investor, if you stop and think about it, really is value wants to buy something that looks cheap, maybe as it has dipped over the course of months, maybe years. And momentum investors are fine with buying the brand new high. So these Apple and Microsoft picks, they're momentum picks. Okay. Trend traders can find success in any time frame, though, even in intraday. It's all a matter of perspective, right? It's like here's the here's the period where prices have kind of stayed in this tight range, and all of a sudden they break out and then they move in a trend. Very typical at the first Friday of each month when non-farm payroll report is released. You get this tight trend coming into it, and then it breaks out and goes one way or the other. Oh, well, yeah, that's what happened. That is exactly what happened this last Friday. See, prices have been getting into a tiny range, small, 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 and all of a sudden this much better than expected jobs number came out in the U.S., and boom, up we go. Apple and Microsoft, not just Apple and Microsoft, all the whole market, right? Apple and Microsoft being led by them or being, just reflecting that move is what I should say. So, in other words, if Apple and Microsoft, if I'm sitting here saying Apple and Microsoft are going higher, I'm also saying the whole market, the whole U.S. market is likely to go higher all the way until the end of the year. That's my fifth slide. So stay tuned here. All right. So the other one is channeling movement. All right. This is wait. Oh yeah, no, no. I'm sorry. I got to come back here and talk about trending movement for a second. Trending um, techniques that are attempting to capture trending movement are best implemented with the use of trailing stops or none. It requires a lot of patience. You can expect to lose 2 out of 3 times. You're doing great if you can win more than 36%, right? This is the thing that people who are trying to go after trending movement and are inexperienced don't typically understand very well. They try to go after trending movement and they try to be right 60% of the time or better. And when they are not right 60% of the time, they say, oh, whatever, this system I'm trying to work with doesn't work. Or markets have changed. Somehow markets are different. No, no, no. This is a persistent style of trading that has, been predicted for over 100 years. People say, trade this way, and there's almost nothing that has changed about it over the last 100 years. There's a big reason for that. That is only seconds away. I'll explain it to you. So that's what trending movement is. The big thing is you can't expect to win most of the time. Hey, if you are, great, you're going to kill it. You're going to make all kinds of money. But if you are just trading by normal standards, you should expect to be the strikeout king and the home run king, so to speak. All right. So channeling movement is not necessarily, a nicely defined channel. Certainly it can be. And if you look at it, you can always sort of draw some lines that kind of make sense. But most often it's really messy. And so the best description of it is prices whipsaw for extended periods, right? That kind of describes the Forex market as of late, right? Prices will follow breakouts with pullbacks, the sort of fake out kind of situation. Now, market makers, high frequency algorithmic traders, or any other kind of short term traders, whether robotic or algorithmic or manual, tend to seek this kind of market. That's what these are the kind of markets they look for because they just want to take quick little bits here and there. Scalping looks for this kind of movement, um, and because they don't want to be in these trades, they want to not have the risk of it trending and going against them, and they also get to win more often, a higher percentage of their trades. So to accomplish this, they try to use the methods capturing um, these ways, capturing this kind of movement by implementing distant stops and defined profit targets. So in Forex, you might say, I'm going to put a 30 pip stop loss, but I'm going to take 10 pips profit whenever it shows up. If the movement goes just 10 pips in my favor, I'm taking it, right? Um, and you would expect to win 2 out of 3 times. In fact, if you did 30 pips to risk 30 pips to make 10 pips, you should actually be expecting to win 75% of the time. But if you're just going to risk two to make one, take 20 pip stop loss, 10 pip profit period, then you would expect to win 2 out of 3 times. But you actually got to beat that just a little bit so that you do better than break even. So the trader has to maintain a 70% win rate or better when doing channeling movement. But this can be highly profitable if you can contain the number of losses you take, the number of times you actually have to take a 30 pip loss. Um, I mean, that goes without saying, right? You higher the win rate, the more profit you make. But really, what I'm talking about is like somehow you have a filter that helps you know, hey, I'm going to take a lot of losses right now. I'm going to take a loss on this trade. I'm just going to bail out, get out early. Um, cut my loss at 20 pips in Forex world. In the case of stocks, it is you're going to get in there and you're going to take the profit. I'm going to, risk $2 stop loss with $1 profit target. But somehow I see something going on and I think, you know what, that's just going to trend lower. A way to do that is to be aware of trending moves. If all of a sudden you see a breakout of support and you say, that's going to break and trend, and you realize it is, get out early. Don't don't hang around. And if you have this filter where you can understand, I've got to get out early, then you can improve your win rate and decrease the losses when you do have the losses. And so that is what makes you a highly profitable, consistently profitable trader in the world of channeling movement. Right now, for the past several months, if you've been in the Forex market, if you're not seeking channeling movement, if you're seeking trending movement, you're probably having a hard time. So having methods that help you learn how to capture channeling trends is much more worthwhile right now. But but the other thing is, markets channel for a long time, all of a sudden, boom, start trending surprisingly, and if you get in the mindset of channeling only, then you miss that when that happens. So you've got to be agile enough. That's the challenge of all trading is to know when to switch or to optimize for one of these kinds of movement or the other, right? So okay, here's the big secret. This is the secret most people don't know. Random data tends to trend, not channel, trend. Yes. It doesn't mean it trends straight up and goes forever and ever. I mean, we're talking, goes channel for a while, but then goes trending. And I've heard some people say the market goes sideways 70% of the time. That is entirely a matter of um, how you're measuring it and what you're calling a trend, what you're calling a channel, what you're going, what is sideways. I mean, if you just look at the U.S. stock market from 1900 to now, or 1928 to now, if you're looking at the S&P 500, all depending on your data set, right? What you see is lower left, upper right. That's a trend. It is within those trends. There are sideways moves, there are reversions, and so forth. But big picture, it's a trend, man. It's a seriously long, strong trend. So every time the market comes down, goes lower and lower and lower, it seems like an obvious play to just be a buyer. But the big guys, Warren Buffett and those investors whose names are famous, they don't just indiscriminately buy. Oh, it's going down, buy more. They have a filter. They wait and look for opportunities that tell them now is the time. Warren Buffett has famously said, when there's panic, when there's blood in the streets, meaning red ink, right? Then that's the time you're a buyer. Um, so it's not when it starts going down. It's when it's gone down and people are, oh gosh, what am I going to do? I don't want to be in stocks at all. Warren Buffett swoops in and is a buyer. Um, okay, so it's mathematically provable that even random data will trend, will pick a trend. Okay, look up something called the Archine Law. You'll see why. And it's also expected, therefore, that channeling movement will come to an end. And that breakouts, however, exactly when it's going to, that's hard to predict. I actually wrote the word unpredictable here. Breakouts occur unpredictably. because you don't know what, you know, something has to instigate the potential for it, and then traders and investors have to act on them. Those are two different things, and it's unpredictable whether both of them will happen. That's what creates the randomness of the market. Events which should trigger price values and investor reaction, market sentiment. So these are the kinds of things that just make it easier to say, hey, the market's random. If you look at the US stock market, it is not just flat random, it is trending random, right? So, how is that the case? Well, what happens with the US market is there's always something nudging it a little higher, and that is inflation, inflation in US dollars. If US dollars become less valuable, then the things you buy you buy with US dollars become more valuable. That's just a mathematical relationship. It's not one for one. It's not, straight, exact, but it is generalized. And that is why I believe you have over 100 years of data that trend in only one direction, generally speaking, because you have this inflation nudging it higher. And we've had strong inflation over the past year as a post pandemic effect. And so, what is that going to do for stocks? Well, you guessed it, push them higher. So channeling movement, although it can extend for, go on for extended periods, it's a little more rare. But um, perhaps because that's more rare, it's true to say that buying breakouts has a statistical advantage, right? Well, the statistical advantage is if random data tends to trend, and then something came along that pushed that data higher, out of a channeling movement into a trending movement, then whatever that instigator is, whatever that catalyst is, has just a slightly less than random or more than random, whatever you want to call it, but slightly non-random component to it. And that slightly non-random component, deterministic, something is pushing something higher, right? That's what we want to capture on market. So we don't need much. We don't need more than a 3 to 5% edge to be able to capture uh, a trend in a frequency that helps us win more often than 36% in the case of, um, you know, trying to grab trends, or 60% in the case of channel. We don't need much of an edge, 3 to 5%, in order for us to be highly profitable. However, uh, just knowing exactly the touch points, where are those signals that tell us things are coming? That is breakout. And at least in the case of, you draw the channel, you have a channel in mind, take it however you pick it, and then you say, uh, price moves above it, or price moves below it if you're looking for the downward trend. And it gets even easier than that. You just simply say new high. Anytime you have price making a new high, that is the breakout. Okay, time to go back to Apple and Microsoft. Guess what they're doing? New high. Apple just made a new high. Microsoft has been making a new high. Apple is kind of lagging behind. Get with the program, guys. We're going higher. Both of these are going to also correspond with the S&P 500, which took a little while, but last week finally broke into the new high territory. The Nasdaq, which of course is already well into new high territory, and here comes DIA, the Dow Jones Industrial. It has not yet made a new high, but with Apple and Microsoft going where they're going, it's hard to expect that the Dow Jones Industrial Average will likewise also not make a high. How about the small cap stocks? Interesting, isn't it? The small cap stocks didn't make this big move higher, right? And yet it keeps pushing against the new high here over the past month. Right now, this is a total indication that the tech sector is going to lead out, which is why I feel like Apple and Microsoft are the best trades, because if the tech sector is leading, that money, because you got 400 ETFs and hundreds of mutual funds, that money is just going to flow into Apple and Microsoft. So that's why we have the trading idea here today. Um, Microsoft and Apple. That's what we're looking at. All right. So I'm going to walk through exactly how to make those trades come Tuesday morning. And I want to do that here, but I want to also see if my expected guest, if Paul is here. Paul, I can't see on in the list, so I don't know if you're here. Then please chat in. Or if Paul shows up, will you please tell him to just chat in and let us know that he's here, because I think he had a bit of an announcement for us. In fact, I wonder if I can. Well, maybe I could just ask you, Mike. Could you chat to him on Skype or something? Let him know, hey, I'm ready to go, in case he um, is waiting for a cue or something. And just let me know one way or the other. All right, we're gonna move on until Paul shows up. So um, what I have here is wait, here comes the chat. Let's see what's up. Oh, yeah, mine. Could you chat to Paul? Paul had said he wanted to come on and make an appearance on the show this morning, but I haven't seen him, and I don't know. Could you just chat to him on Skype and let him know that we're ready? Yeah, Paul Botterill. That's right. Okay, perfect. Now, while she's doing that, um, while she's grabbing Paul, then let me tell you how we're going to set up the trades. You can look at the Apple and Microsoft trades either way as oh, now I've got them kind of shifted around here. Oops. Um, yes, I can type. Okay, there. You can look at these in any number of ways, but what we've done the last 2 weeks is we have taken a trade based on the idea that, hey, it's run up high. We're going to go ahead and expect to buy the opening of the next trade, or we're going to expect to, you know, be able to bargain shop it. Now, this is Microsoft and Apple we're talking about. I would expect that they are going to pull back. Um, so it seems rational to expect that that you should be able to set up a trade where you could kind of buy lower down here. It seems rational, but I'm very concerned, very skeptical that we would miss the trade if we did that, because um, because of the 3-day weekend in the U.S. The news came out on Friday that jobs. Let's see. If you don't know about this site, then you should hear Forex Factories. I mean, I would imagine everybody here knows about this site, but I'm just going to run back to the 2nd of July, Friday, and point out the non-farm employment change. So look at these numbers. Um, the expectation was that 725,000 jobs were going to be reported as having been created in the United States, but what came out actually was 850. And there's variety of reasons for why that is, but it doesn't matter exactly why. What matters is people were excited and surprised to hear that it came in so high above expectancy. There's that gold line is the expected number. That's where it actually came in. Notice also that since the beginning of the year, um, this is not quite the highest, second highest. This one was this big shock, but it was at the end of a quarter, right? So I couldn't tell you for sure what that might be related to, but the fact that it's happening at the end of the quarter is really interesting. It might be something. Okay, thanks, Mike. Um, it might be related to the way people are counting. In other words, somehow early part of the quarter numbers are not rolling in fast enough, or being delayed or discounted, and then they're kind of getting piled on, and so then all of a sudden the numbers, accidentally come. Don't know. If that's true, then we'll have a repeat of this whole thing in October. All right, but regardless, there's this big news that came along, and the big news um, drove both of these stocks higher, and uh, so people are now going to have 3 days to percolate on this. And if they come back with, "Wow, things are going up, quick, we got to buy this stuff," then what's going to happen is it's going to gap even higher. Not super high, probably not this much, right? But it is going to open high and then continue higher still. That's very plausible that that would happen. So I'm actually a fan of trying to, buy the market. Go ahead and buy the open for Microsoft or Apple or both if you wanted to take both trades on Tuesday tomorrow. So let's take that trade from that point of view. What kind of trading setup, should we create? Do this date and price range in order to expect for us to, you know, grab the price wherever it opens. Let's say it's going to open a little bit higher. Microsoft 277.86, and oh wait, no, that's not the right drawing tool. I want the long position. Going to be up here. No, here. Where's my long position drawing tool? Oh, there it is, right on top. Okay, long position. There it is. So 277.68, and then I'm going to set my stop. I want to set this stop well below the old breakout, right? So somewhere about down there. Now that might look like a big stop, a very generous stop. That is to say, $6.60. And I'll admit that looks pretty long. If in fact we were to say 660 stop and target, if what we wanted to do was capture a reversion to the mean trade. This is weird to talk about this kind of trade this way because, hey, we just broke out. There's nothing reverting to the mean about expecting to go higher. But if you forget everything that came in the past and you just say, where I am, where I start the trade, that's the middle. Everything up, everything down. I expect that it's going to go in one direction, in this case up, but that it will eventually come right back down. It will revert to the mean. So I'm going to take a short puff, take that quick move up before it comes back. That is still reversion to the mean trading because I'm betting that it's not going to immediately trend from here. So if I wanted that kind of trade, then what I should do is set a fraction of the stop loss. In this case, the stop loss is $6.60, 2.4% lower, right? Then that means I'm going to go about zero point 0.8 higher to 20, something like that, right there. So if I were to do a setup like this, where I buy that level, put my stop loss clear down there, and I take profit right there, really good chance, really good chance, 75% chance or better that I will get that profit. Boom, done. Um, Within the first 5 days of, or 4 days of trading, within the next week. Very strong chance, 75% chance. So if you set the trade up this way, you're good. If instead you like the idea of, hey, if this is going to be a new trend, I want to let it run, then what you should do is set your profit target much higher. You should set your profit target something like 5% higher. So $6 and $6.50 stop loss, $13 or more higher for profit target. In fact, don't even actually put your profit target in the order. Just let it be a mental profit target. Have the stop loss in there, but let it be a mental target. And just when it gets to $14 profit, then say $14 per share on Microsoft, we're talking about, right? When it gets up there, then say to yourself, what does the price look like? Does it look like it's about to revert to the mean? Does it look like there's resistance? I'm going to move my stop loss to break even, but there's a possibility it could trend even higher. So I'm just going to let it trend if it will. Then I'm going to move my stop loss up, you know, about every anytime it makes a significant new high and closes above the high, then I'm just going to move the stop loss up to the lowest low of the last 10 days or 20 days. In fact, there's an indicator for that on the chart you can use called the Donshan Channel. In some other trading charting platforms, it might be called a price channel or just channel or envelope. Well, no, it's not envelope. Envelope's actually a different thing. So there's various names, but basically what it does is it just tracks the lowest low and the highest high in the last X time period. All right. So right now the default is set for 20. I'm going to change this to 10. I'm going to back up and show you what that looks like. And I'm going to take off the upper and basis, keep the lower, make it a little thicker so it's easy to see. Make a black line. I can make it as thick as possible. We'll take out the background. So this line, this black line, tracks the lowest low in the last 10 days. Whatever the lowest low was out of the last 10 trading sessions, that's what that is. So let me just show you really quick here. Imagine this breakout of just the previous week was the trade you were interested in. And you set your stop loss down here at the lowest low of the last 10 days. When do you move the stop up? Not until you see this new breakout. But then what do? You come back and you set the stop loss there at the lowest low in the last 10 days. Wherever, when the breakout occurs, wherever that Donshan channel line is, that's where your stop loss should go. Breakout, wait, it's still here. Breakout, still here. Don't move it. Breakout, oh, now it's moved up. I can move my stop loss up to here. And then you do this. This turns out to be a very effective way of letting your trades trend. You stay back away from it. Now, true, if all of a sudden we were to get this huge sell off and it came all the way down, yeah, you're going to give all that up. That is so rare that this happens in the way we're described here, that it is worth taking the risk of doing it. Because what happens? You come back and you get stopped out at some point less than where your original stop was. It might even be profitable this time, depending on when you started the trade. Right? The downside of this is it takes a long time. If you're somebody who likes to trade in 1 to 4 weeks, this takes a lot longer than that. This takes several weeks, several months going this way. If you want to decrease the time frame, then go a 5-period stop loss. That's going to push this up tighter, and it's going to get you out of trades, but it's also going to allow you to get back into them and make more frequent trades. If you like the idea of being a position trader, sitting back for multi-months, suppose Microsoft doubles this in the next 12 months. We don't know. Suppose it does that. If it did that, how could you ride that for a whole year? A great way to do that would be to use the Donshan channel on its default setting 20 days instead of 10, right? Now, this is really hard to put up with as an active trader for your early days in the trade. See how this happens? You break out here, you get in, there's your stop loss. That looks nice. And, I can put up a bet that's not that far away. But then all of a sudden, you go way up here and your stop loss is clear back here, right? That takes a lot of patience. Months into the trade as it keeps going and trending in your favor, then all of a sudden you're feeling like a genius. But at this point in time, it's early on, it's hard. So that's why it takes patience and it has to. Okay, no problem. If that changes, let me know. Sometime in the next 20 minutes. Um, okay, so so that's really hard for short-term traders to do, but it turns out to be probably the most effective, most reliable, most risk-efficient way to capture a multi-month trending move, right? So those are the two ways you can put this trade on. Is that sort of grab the profits, or the other one, sit back and let it run. Um, and what I would recommend is that people who aren't quite sure what style of trading really suits them, what really fits them, try both. Try one trade as a trend trade and one trade as um, a reversion to the mean. Quickly take profits. Um, and you can make the debate about which one it would be. From my point of view, I like the idea of grabbing a quick profit on Microsoft and letting Apple run and trend. Because Apple's kind of lagging behind, I think it'll catch up and especially come through the last 6 months of the year. But either way, right, I would suggest that your stop loss doesn't have to be much deeper than where Friday's gap started, right? Now, if you've been listening to me for a while, you know that gap trades have a statistical advantage as well. This fits every one of my, you know, trending or statistical advantage trades. It's the gap trade, it's the breakout trade, it's the tall range day trade, everything. The only thing it doesn't pick off is the 10 period moving average. That's when something trends down and then, gaps up over the moving average. That has a statistical advantage. But this isn't that. There's also one of the things I've taught in my classes in the past is which I'm supposed to be teaching class today, but we moved that out, which was kind of a bummer. I was really hoping that I could get a bunch of people to come and hear my research about the Keltner Channel trades. In fact, maybe I can bring a chart up to sort of show what those look like here. I think I have that all set up in one of my layouts. Yes, there we go. So what I've found is that if a stock pushes into this upper region here. The very first time that it turns into that upper region, that is a um, statistically uh, significant event. There is a better than average um, statistical chance that this stock will end higher 20 days later, 20 trading days, 1 month higher. The first day it closes outside of that range. And there it is, Apple doing that. So yet another one of my trading systems all converge. Apple, Microsoft, both of them looking fantastic on all sorts of these scales as momentum trades. And that's why these are my two choices for today, opening up tomorrow morning. So literally, you would consider buying the open and setting a stop loss below the gap from the day before. So let me set up Apple now. I did Microsoft. And I think having Microsoft $6.50 back is the right stop loss. In the case of Apple, I mean, the very most efficient and aggressive stop loss would probably be right there, just below the gap. But I'm kind of thinking Apple's it might need a little bit more. So you might want to take Apple all the way down here to 135. Let's imagine that we were going to set up a trade based on that though. And so what would it look like? Well, all right. We would see if I thought it was going to come back though, I should admit that that means I could probably bargain shop Apple. Now, I'm going to show you that setup, but I personally feel like just buying the open is the best thing. However, because I already showed that with Microsoft, let me show here with Apple what you do. You look down this candle, you take about halfway down, just visually, estimate. It's about 138, 139. Don't go there. Don't try to go that much or lower. Something that much or higher. So we'll say 139, let's call it 139.25. That's probably the price you could bargain shop. That is, you could target trying to put in a limit order for 139.25, and then your stop, even if it came all the way back down to 135. See, that's only 2.6% lower. So it's not crazy generous stop. It's actually quite tight. But it also happens to come in lower than this area here. See, whoever it was that felt like they had to sell their shares of Apple, whatever hedge fund or what, they did so. they're done. When they got here, there was a little bit left. That's it. All that's gone now. So we don't have the overhead resistance. If in fact we came all the way down to here, back to this area where selling occurred to push prices down from, then this would be a huge fake out. It would not be a trending trade. Therefore, that's a good point to say, I'm out. I get in the trade with Apple, but if it doesn't, if it comes back more than that, I'm out. It's not doing the trending behavior it should be doing right now. And I'm not going to try and take advantage of it. Here, on the other hand, we're going to say, um, set our stop loss at least twice as high, but I'm just going to put it off the chart because don't even put one on. Just put the stop loss on and let it trend. And then just move the stop loss up little by little and let it go. That is the best way to capture trending movements because, as the Archine Law points out, it tends to trend. Random data tends to trend. If we're going to go random from here, but we're going to get nudged a little higher somehow, then this is an automatic, easy trade. Just let it go. Let it, play out in your favor. So that's the trading setup that you could do if you wanted to bargain shop Apple. You wouldn't want to go much lower than 139.25, um, and then set the stop loss back here at about 135 and a half ish, anywhere in there. So long as you're below this candle right here and below the high of that candle right there. Um, one more thing back on my slides. This is fun. So I went through all of the proofs, but the final one, this is fun. This comes from Ryan Dietrich, who is the chief market strategist of um, LPL Financial, and they do some great research. Uh, he posted on his LinkedIn feed, which I'm connected to him on LinkedIn, so that's how I saw him. But I think he's actually there's a blog out there, LPL Financial, and so you just Google LPL Financial research blog, and you'll find your way to where Ryan posts his stuff. Lots of good stuff all the time. But this was really fun. He says if the S&P 500 index is up more than 12.5% in the first 6 months, then these are the stats you get, and they're usually good, right? So these are all the years in the last 50 that, or 60, I guess, or whatever, that it has done that. And here we are, we're up 14% so far. Now there are a lot of people like S&P is up 14%. Average over all of its time is somewhere around 7% if you include the dividends. As you can see right down here, the average year is 4.7% without dividends. And the most frequently occurring year is 5%. But but when the market has already gone up 14%, shouldn't that mean we see a reversion to the mean? Because if the average year is only 5%, then yeah, we're going to pull back, aren't we? Most of the time, that's not what happens. Out of this list, there have been 3 times where the year has actually gone negative. Notice the one, 1987, did that all in one day, literally, because when that day came down for the rest of the year, it trended higher, and where it ended was that much lower from July. Major outlier. I mean, we've never seen anything like that where the markets have gone up and then dropped and ended the year so terribly low. There have been 3 years, but most of the years are much better. Really good returns for the last half of the year. Even this 3%, I mean that's only 6 months. That's still on target for 6% more than average for the S&P. So we look down here. What is the average return during a 6 month period of time after the markets have already gone up more than 12%? The answer is 7%. That's crazy. You're going to get 7% more on average based on what we've seen. Now, it's kind of a small data set. I give you that. But the most frequently occurring, 9.7%, percentage of positives on these, 75%, right? Compared to all years, 70%. Why would you try to trade any other market besides US stocks? when you've got a 70% chance of ending higher every year. Apple and Microsoft, I made the thing, I made the prediction, 70% chance that it's going to end higher than where it is right now. 70%. That is all years, random. 70% chance that we go higher after the first 6 months. These are 6 months specific, not a whole year. Whole year is more like 65%. So 70% chance of buying here in July and seeing something higher. But this particular setup that we're looking at actually has a 75% chance. We're on a 12% already. Why would it be that the more you go up, the greater it increases your chances of ending higher still? Because what I told you at the first, random, the persistent movement in stock in the case of trends is that even random data tends to trend. The Archine Law shows why that happens. And in my class, I actually kind of walk you through the steps of how that plays out. All of this that I'm trying to describe to you is helping you understand, yes, it is mathematically expected. There is a statistical edge of trading right now in the markets. Yes. Now, I'm the guy who said, hey, markets are going to potentially have doomsday at May 14th. To be fair to myself, though that didn't happen and I was wrong, I also said it may not happen because all the conditions could arrive and yet people don't act on it. Right? Earlier in this presentation, I said you got to have conditions and people acting. Well, they didn't act on it. That being said, I was able to make money on Apple by buying put options, going to the short side during that period of time. So I put on a trade back in the days leading up to May 14th of trying to capture Apple to the downside, and I did capture it. So fun little fact here. I did that trade in multiple ways and made money on that trade. Um, I even made money, through this period here as Apple kind of went down and then sideways and up, and proved to be wrong. And yet, I bought a put option, then I sold put options against it. The put option version of a covered call trade. And so that was really fun because I got to make money even when I was wrong. But I also did something else. I had an account. I thought, let me just test a theory. Uh, it had $20 in it, a U.S. trading account that I had used in the past, and then I moved money out, but I left $20 in just because I didn't want to close the account. Let's see what I can do with that $20. Because Apple has such efficient and tightly priced options, I found that I could put on a calendar spread trade for just $20. I put on a put spread here, $20, and by this point down here or here somewhere, um, wherever it was when I decided to get out, probably right here because that's starting to go up. Anyway, um, that value of that was up to $25. So I took a $20 account and took it to $25 just with that trade. And that was fun. But had it been right about May 14th, actually creating a doomsday scenario, Apple would have gone clear down to 100, and that trade could have made a $20 account worth about $100. Could have paid out 5x. And so I thought, okay, well that's fun, but um, here I made 20% on this tiny little bit, and I was wrong about the trade. You gotta love that kind of trading, right? Now, when it turned around, I decided, Apple is probably going to do the opposite. It's probably going to trend higher from here. And so I put the trade on the opposite way, a calendar spread that would last all the way beyond Apple's earnings. So the front month expires in August and the back month expires in September. I put that calendar spread trade on, and it only cost, you got it, 25, less than $25, like 23. I still had to pay commissions. Right? I got to pay $1.30 per contract. I mean, 65 cents per contract. So $1.30 just to get into the trade. It cost me $1.30 to get out. I made 20%, even paying crazy big commissions. It's almost 10% of a $20 account on the commissions, and yet I still made 20% on that last trade. Now, because of this big breakout right here, that trade is actually $8 to the good. So it is the account value is worth $33. Think about that for a second. This is a $20 account. I mean, it's amazing that I can buy an option trade for just $20, but on Apple you can. And since April till now, right? We're talking 3 months. In 3 months, that trade, that the value of that $20 account is now over $30. So it had more than a 50% gain on two trades. Now, it would be a little foolhardy to take, say, a $200,000 account and try and replicate these trades that I did. Put your entire account in it, because the truth is, um, the risk on that trade is total. Yeah, I put in $20 risk. I could lose all of it. If I'm wrong about the trade, I could lose all of it. So I look at that and I say, well, why would you do that? You would never do that with it. Of course you wouldn't. But it's a $20 account. You could replicate this kind of trading with a portion of your account. You could say, okay, here's my big 100,000, 200 million, or maybe even just $10,000 account, whatever. But I'm going to take this tiny little portion in here, $100, $200, $20, whatever small amount you want to do, and try and learn and try this strategy out. What is the strategy? Calendar spread as a trending stock. Instead of buying the stock, you buy a calendar spread and you let it trend for a period of weeks. That's the trade. The setup right now is actually perfect for that kind of trade. And what would you do? You would buy a out of the money call option, something like $150. You'd give it enough time. Let's suppose you bought a October um, something that would grow. Actually, let's go November. Yes, November. You should try to buy something that expires in November if you can find it for Apple. If not, then October. And then you sell the one right in front of it. 150 might be too close. You might have to go 155 or 160, but but that's the point. It's going to be way out of the money, right? You're going to buy the one, and then you're going to sell one that's even closer, a month or two, just 1 month, just the next possible expiration. That's going to keep the price of the spread really low. It's also going to eliminate the time decay that happens. If you buy an option, if the stock doesn't move, if it just sits there for a long time, then you lose money on your option. Even though you're not necessarily losing money in the stock price, you are losing money in the option price. But in this case, a calendar spread where you buy an option and then you sell the same strike price option, but at a shorter expiration period, then that's collecting time value while this is losing it. So on net, you end up actually having time value work in your favor. The fantastic part about a calendar spread, which is why I was able to make money on that other one, even when I was wrong. Wasn't moving very far, it's fine. I'm still collecting the time value. So right now with Apple, at a minimum, out of the money, you'd be looking at 150. It might be more like 160 that you end up. So if you look at that, like Apple, is Apple really going to get to 160? Yeah, we're talking. As weird as it sounds, Apple could go up 50%, maybe even double by the end of the year. That's not what I'm predicting, but it's not impossible if, in fact, if the market as a whole is going to go up, 75% chance that it will go up on average 7%, right? It could go up another 10 or 15% when you think about all the money that is being printed in US dollars. And the value of the dollar could drop so much, and the value of things that the dollar buys, in this case stocks, could go so much higher. You literally could see Apple double in the next year. I think there's less than 20% chance that happens, but 50%, I think there's a pretty good chance that happens. So Apple goes that high. um, then that's talking about 210. If you buy a calendar spread at 160 and it's on its way to 210, well, as it hits 160, then you got a couple of choices. Either you just take the trade because at that point you're making you're making a lot more money than what you initially risked, or you just close the one that you sold and let the other one ride, and then of course you have this incredible lottery winning trade if that one plays out. Chances of that happening are very rare, but if you have the trade set up, then when they do happen, you cap. So anyway, that's the longer term play, and it was just a fun little experiment. Two trades and this tiny little account. I'm going to keep the experiment going and report back to you about it. But meanwhile, this week's trades, Apple and Microsoft, the setup is give them a little room, make sure you cover the gap, and let them trend. That's the best way to make these trades go. Until next time, everybody take care and trade well.